Hey everybody, Don Winter here. So we're going to get started in about a minute and a half or so. I opened up the room a little early so people could jump on, but we'll give it to right about 1 o'clock to get started. Thanks for jumping on. For those of you new to Zoom, if you're logged in on Zoom, there's a Q&A button. You can type in questions as I go along. I'll make sure to answer all questions. And then if you're on YouTube, of course, there's a chat function there as well. But we'll get started in about a minute. All right, everybody. So we're going to go ahead and get started here. Again, my name is Don Winter. For those of you who we haven't had a chance to connect yet, I'm the CEO and founder here at DLP. And I'm going to go ahead and walk you through a little quick bit about DLP, and we're going to dive right into, how to underwrite multifamily investments and how we do so in order to mitigate risk and to maximize our investment opportunities. So quick bit about us, you'll hear and you'll see, and maybe that's what brought you to this webinar is, we've been able to generate some really great returns across all of our investment strategies here, especially our multifamily strategies over the last many years. But what drives us here in the topic we're going to talk about here today in underwriting, as well as what drives us in all of our decision-making in investing capital is these three rules here that you see on your screen. The first rule is do not lose money ever. And that's a really, really, really critical way we think about investments, how we think about our underwriting is losing money on an investment is not an option for us. The second thing we focus on is generating consistent returns. So although there's a lot of great investment strategies out there that can provide, big one-time or maybe multiple time paydays, we believe in making investments and focusing on investments that produce consistent returns every month or every quarter, that our investors can count on. And then we do want to generate the highest returns we can without taking risk of principal loss and with being able to generate consistent cash flow to our investors. Quick bit about myself. I started DLP a little over 13 years ago now. Since then, I've closed more than 13,000 real estate transactions, a little over $2 billion. We've acquired more than 12,000 homes and apartments, ranked as one of the top real estate professionals by the Wall Street Journal, currently own over 10,000 homes and apartments with our investors. And I'm the founder and CEO of each of the DLP businesses, DLP Real Estate Capital, DLP Capital Partners, Direct Lending Partners, DLP Realty, Property Management, Bright Homes, and Alliance Property Transfer. I'm the father of those two little boys right there, Donnie and Alex. Donnie is the taller one on the left in the large picture, and my wonderful wife, Carla. This is the leadership team here that drives results at DLP. If you've been with us for a while, as I know some of the names here in this webinar have been, you'll notice this screen keeps growing as we've been bringing on a lot of really tremendous talent. One of those talented people that we just added that's worth mentioning in context of this webinar is Hector Rivera. Hector is a new director of investments with us, comes from another multifamily operator. He acquired over 6,000 apartments in the past 2 years alone in his role there, leading all underwriting and investment decisioning. So it's going to be a great addition to our team. He starts with us on Monday. Great team of now 25 key leaders driving results and mitigating risk here throughout DLP. These two gentlemen here are two partners here in DLP Capital Partners. Bob Peterson is our CFO and Barry DeGroot, our Chief Legal Counsel, are also both members of our investment committee. And this is the team that drives results specifically for our investment funds, specifically here at DLP Capital Partners, including our managing directors, Rich and Dominique. And Dominique's our newest managing director and senior counsel, joining us a couple months ago. And probably most of you now know Larry, our head of investor relations, and Bob and Mike, our investor success managers. And after this webinar, if you have interest in diving more, one of those three gentlemen will gladly work with you and follow up with you. And then our amazing accounting and support team, coordinating distributions on time every period, and great consistent reporting and insight. So, all right. So with that said, when we talk about investing in multifamily, underwriting multifamily, we're not talking in theory. We're not talking in practice of what you should do. We're talking about what we actually do, and we actually own over 10,000 apartments right now. This year, we've acquired about 2,300 apartments so far this year. We've also sold over 2,000 apartments so far this year, and we're under contract and expect to close somewhere around 1,500 apartments between now and the end of the year. On the screens here, you'll see some of the apartment communities we own in our portfolio at the moment. Here is our portfolio on a map, although we are also out in Arizona and Oklahoma now. It falls off this map as we'll have to expand this out, but again, own about 10,000 apartments throughout our portfolio. So how we go about mitigating risk and buying these types of apartment communities, which are mainly B-class apartment communities, generally in the South, I'm going to walk you through. So in buying B-class multifamily, but really these rules apply in all investment strategies. Here in the B-class multifamily space, though, it's easily the most desired asset class in all of real estate today. There's been over $30 billion in capital raised to buy B-class multifamily in the United States just this year alone. Pricing is at all-time highs. And people are paying, not only are they paying all-time high prices, but they're paying all-time high cap rates, or the lowest yields that anybody's ever bought these assets at. Generally, we're seeing for smaller B-class assets in less desirable markets, people still paying low 5 cap rates and even 4 cap rates. And if you're not familiar with the term cap rate, it's what your return would be if you bought the property all cash from an operating standpoint. So people are paying prices where normally those types of assets would sell at a 7 cap rate or maybe an 8 cap rate, have been steadily creeping down, and people are paying in the 4s and 5s and maybe low 6s. You'll see properties on the market selling at highest. And for us, it'd be very easy to go out there and buy lots of apartments at that kind of pricing. That's what everybody else is willing to pay right now. For us, though, we have to be able to hit is over an 8.5 cap rate on B-class multifamily by our second year of ownership, which means our cost basis has to be significantly less than where the properties are selling at today, where buyers are willing to pay today, which that takes a lot more time, effort, and energy to find those deals, to negotiate the deals, and then to be able to drive value in those properties to get to those kind of returns through our value add strategy. Another way we mitigate risk through this strategy is we put in long-term non-recourse debt on property, especially if we're going to hold on to this asset. Sometimes we'll put bridge loans on the property in our first year, but then we put in long-term non-recourse debt, meaning we're locking in our loan interest rate for generally 10 to 12 years, meaning our rate can't go up on us in the next 10 to 12 years. And our loans are non-recourse, meaning there's no guarantees or personal liability to the loans. So we take away interest risk and we take away risk of the loan. So ways that we go about finding these types of deals and mitigating risk is first is having strong deal volume. So we're looking at hundreds of deals every month, which I'll show you further in a moment. So by having great deal volume, it allows us to make sure we never, we don't only have a couple deals we're working on that if one deal doesn't work out, we're not going to be able to find another deal. We're not going to be able to deploy capital, and being able to find enough supply is a problem for many groups today. By us having a large deal volume, it's taken us a lot of time, effort, energy to build relationships with brokers, directly with sellers, banks, loan servicers, auction houses, et cetera, allows us to have a very large volume of deals to evaluate, and allows us to make sure we focus on these really big fundamentals right here. Of strong double-digit cash flow is a really big one. We need to be able to be confident we're going to generate double-digit cash flow once we go through our value-add strategy, and we need to be able to generate north of an 8.5 cap rate, as we talked about here on the last slide. So, in doing this, generating this kind of cash flow and generating this kind of cap rate while using very conservative underwriting, which I'll show you exactly how we underwrite in a moment. So our process to go about finding these types of deals, doing the underwriting, mitigating risk, and then getting these deals closed is here as follows. So we're looking at 300 to 500 deals every month, of which 40 to 50 of those deals we go into full underwriting and evaluation on. Then we go out and do site visits, put out offers, and get a very small number accepted. Generally, we're only getting 1 or 2 deals a month that we get to the closing table out of hundreds of deals we're looking at. So out of those 300 to 500 deals we look at, generally we have either a full offering memorandum or presentation on that property brought to us. In many cases, we're just getting some financials from the seller or from a broker or from a bank on that property. And then we're diving into those financials. We're putting together our own assumptions to what we'll be able to perform that property at. We're doing research on the history on it. We're doing research on the occupancy, on the resident base, on the historical trends, on the community, the geographic area, the competition, and doing an initial analysis to determine, is this a deal that we're interested in? Is this a deal that we think there's a chance we'll be able to buy it at a price that's going to work for us? And out of those 300 to 500 deals, that narrows it down after spending anywhere from an hour to 20 hours doing our initial analysis, to then narrow the list down to about 40 to 50 deals a month that we go into full evaluation. We have 4 full-time analysts. That's all they're doing is analyzing deals. So we're paying salaries on 4 full-time people to do this. So they analyze the financials, they do full underwriting, they match up with our acquisition guidelines, the way we make assumptions to the future. They analyze rent rolls, operating statements, leases. They do a full, complete investment analysis in a underwriting workbook we use to analyze all risks, to do what we call sensitivity testing. They go and pull reports from a system called CoStar, which is the largest and the most expensive source of data for real estate, where we can then pull all the history on the property, the mortgage history, the track record, all the past financials, determine all the rental comps, determine all the sales comps, get all the insight on every property that is sold, who's buying, who's selling. We pull crime reports, demographic reports, et cetera. So we do a tremendous amount of time and effort. This could be anywhere from 20 to 100 hours we're spending on each of these deals in this stage. Then if those deals pass that test, then we go out and we look at the properties. So we walk the exterior of the properties, go through the amenities, walk through 10 to 50% of the apartments. We meet with the local management teams. We meet with potential partners we'd use in that market, whether it be construction companies as an example, or vendors. We go and walk the competitive communities, the other communities that a potential resident would be competing or evaluating to go move to. We'll go talk to down to the municipal building and check on zoning and open permits and violations. We'll go talk to the local police, especially if we think there might be any crime issues. We'll spend a lot of time on the ground understanding the market, the asset, the competition, the residents, the current management, to get a full understanding of the asset and where the opportunities lie. And that can a lot of times involve multiple people flying out, spending 2, 3, 4 days on site, spending tremendous time, energy, and effort. Then about 5 to 20 of those deals, we end up putting out some level of an offer, and we do offers in a number of different formats depending on the deal. Often we're offering out a significant deposit with our offer. We're then often getting into interviews and presenting to the sellers. We're going and leveraging our reputation of closing and being good to work with and having the ability to execute and having control of our capital, our reputation with brokers and lenders and other operators to give credibility to the seller who's choosing if they want to accept our offer or not, to help us get our offer accepted. So despite all that energy and effort we put through this process of making sure our offer stands out, we only get 2 or 3 offers accepted out of all of the offers we put out. So somewhere around 20% of the properties we put offers out get accepted. And then we go out and do even deeper due diligence. So we get our full team out there, construction team, investment team, property management team. We get contractors out there. We inspect every unit, take photos, comments, notes. We get an engineer to come out and do a property condition assessment report. We get an environmental report. We get an appraisal done. We do a full what's called lease audit, where we evaluate all the leases and match it up with the financials and rent roll they provided. We go through all the historical financials. We match everything up versus the source data versus the actual reports we received. We spend, between the manpower we put out there, we spend hundreds of hours I'd estimate about 500 to 800 hours through this process, underwriting the asset and determining, are we willing to buy this property? Are we, if so, are we good at the price we originally negotiated, or do we need to renegotiate? And we go to the police station, the codes office. We get terms from our lender partners on the property, get their opinion and underwriting on the property. We draft a full capital improvement plan on the property. We build out and detail out our rent projections and expectations. We detail out our operating expenses. We get insurance estimates. We spend a lot of time making sure we get title insurance done. We get flood certificates pulled. You add up all these steps, we end up being well over 1,000 hours to as many as 2,000 hours spent at this point in the process. And we've invested $75,000 to $100,000 on average at this point. And then we're determining if we're accepting, terminating, or renegotiating the purchase based on those findings. Through this whole process, we're going through internal due diligence as well. And again, more steps here. We get financing terms, surveys. We evaluate if we're going to hire. If the deals move forward and they pass our due diligence, we're moving forward. We're interviewing the on-site staff and determining if we're going to hire them. We're then dealing with onboarding the whole team. And throughout this entire process that we're going through due diligence, we're going through investment discussions and investment committee multiple times through this process. So at this stage here, when we're underwriting, looking at lots of deals, they go through our managing director, Anthony, to review the deal and determine if we're going to underwrite it. So he does a review of the analyst's work. And then at this stage, if we do our full evaluation, we determine if we're on site, it gets brought forward to a weekly acquisition meeting. And then I weigh in, our whole team weighs in, determine if this is a deal we want to go on site and dive deeper into and bring forward all the issues and concerns. Then before we submit an offer out, it goes through a committee to decide and agree to the offer we're willing to put out, the terms we're willing to offer, the pricing. And then once we're going through the process of submitting an offer and determining if we're going to adjust our pricing, it goes through committee approval. And then once we complete these due diligence findings, it goes to a final committee with a final investment memo to approve the deal before we move forward with a final commitment. So a tremendous amount of time, energy, and resources spent to make sure we're going to be able to hit our returns, make sure we've evaluated and turned over every rock in terms of potential risk, make sure the deal is going to hit our return targets. And then once we do all that, then we have to onboard the people, the properties, the residents, perform final lease audits, onboard all the team. We send our cultural team on site, as well as our sort of welcoming committee in terms of both people and management, and keep people from our corporate team, our HR team, out on site to work with the team for the first week and help integrate them to our systems and ensure a smooth transfer. We get announcements out to all of our residents. We launch all new marketing, launch a new property website. We get residents signed up for our online payment portal. And then sometimes right away, but more often some point in the first few months, we change the property name, we replace all the signage and marketing, and then we mobilize our renovation team and plan soon after closing as well. And again, throughout the whole process, we're having investment committees, evaluating the findings, evaluating any red flags and opportunities, and finalizing our projections. So it's a pretty extensive process that we go through on each investment before we invest our capital or your capital into these assets. And through this entire process, this entire time that we're evaluating these properties, we're making very conservative assumptions. And these are the general assumptions we're making. We're assuming that once we stabilize this property, that we're only going to see about a 2% revenue growth each year, meaning that rents are only going to go up 2% a year. And yes, it's true that rents have been going up 4, 5, 6, 7, 8, even 10% a year in many markets. But we're not willing to make the assumption that that's going to continue. So we use what anybody would consider a very conservative assumption to rent growth. We assume 93% effective occupancy once we stabilize the property. So we assume there's going to be 7% vacancy. We assume that expenses are going to go up just as fast as revenue goes up at about 2% a year. And then maybe the biggest assumption of all is we assume that when it comes time to sell, that cap rates are going to be much higher, meaning pricing is going to be much lower when it comes time to sell a property. So if we came in and added value to the property, renovated it, stabilized it. If we were to sell it today, let's say we could sell it at a 6 cap rate. We assume when we're going to sell it in, say, 5 years, we're only going to be able to sell it for 7.25, 7.5 cap rate. So we assume pricing is going to be much softer, meaning we're able to sell for a much lower price. And the deal still has to work, and we still have to be able to hit our return profiles, which we'll show you in a second, with this level of assumptions. So to give you a comparison, a real life comparison, this is a community we bought about 10 months ago. It was called Laurenz Place in South Bend, Indiana. Now it's called Prosper South Bend. Big community, 740 apartments. 740 apartments near Notre Dame in Indiana. Some of the units were renovated like this, and we're continuing this business plan. We've been renovating these apartments. A lot of big indoor pool, great amenities, had low rents, had 180 vacant apartments when we bought it. Been basically poorly managed, but was really a great buy. So we used our assumptions as I just described a moment ago. We assumed that we're going to get these apartments renovated and rented, that we're only going to see 2% annual rent growth. So what our assumptions were, what's on the left here, 2% expense growth. We assume when it comes time to sell, we're going to be able to sell at a 7.5 cap rate, and we assumed a 7% vacancy. And then we assumed that we'd own the property for 5 years. And the returns that produced for us was a 20.1% IRR, internal rate of return, a levered IRR, meaning factoring in the loan we take out in terms of our returns. And if we didn't take out any loan, it would produce a 10% IRR, which basically means it'd be a 10 cap rate, a 10% average cash on cash return with no leverage. But we do leverage. So basically we underwrote it to a 20% IRR. And that we'd return investors 2.08 times their money back in 5 years. Those are pretty good returns, right? Hence why we bought this property. Other groups that we come across all the time, and actually a group who originally underwrote this deal when it came to us, underwrote the deal, what's on the right here. They assume that they'd get 4% annual rent growth. Is that possible? Sure, probably realistic. But not something we're willing to base an investment decision on that happening. They assume 2% expense growth. They assume that they'd be able to sell the property at the kind of pricing they'd be able to sell it at today, a 6 cap rate. They assumed only a 5% vacancy rate versus our 7, and they assumed they'd sell it in 3 years. So anytime you shorten the horizon on a property, generally it's going to increase your IRR. So based on this operator's underwriting of the same property, it produced a 54% levered IRR, 26.4% unlevered IRR, and a 3.67% multiple. So of course these numbers are more desirable. Of course, who wouldn't want to get a 50% IRR and a 3.5 times your money back in 3 years? That sounds, really tremendous, of course. And hence why we bought this property. It really is a great deal, and we expect to exceed these return profiles by quite a bit. But in order for the deal to pass our test, it has to hit these kind of metrics, at least a 20% IRR over a 5-year hold using these assumptions. So we know that if we're underwriting this conservatively and it hits these numbers, we're going to end up likely doing better. But if you look at this specific case, this was a good investment. I see a lot of deals where guys go in and they put these kind of assumptions in place, 4% rent growth, 5% vacancy, aggressive exit cap rates. And then the deals end up producing returns similar to what we have on the left. They bring me a deal and say, hey, we're going to get 20% or 23% or 26% or 30% IRR. And they're excited telling us this is such a great deal. And then we go through and underwrite the property, and that deal that they're showing at a 20+% IRR, we're underwriting to a 5% IRR, or sometimes even a negative return through our conservative assumptions. So you have to be very careful making investment to understand what are the assumptions to what's going to be able to, what the value add strategy, what the performance is going to be from the day you buy it to the day you sell it, including what's going to be the pricing and how did you derive that on what you're going to be able to sell the property for. And it's a big factor. And you can make any deal look like a good deal in Excel by simply getting more aggressive with the assumptions. All right, so if you're interested in investing in multifamily real estate, you can certainly go take exactly what we just talked about here and apply these types of underwriting assumptions and do everything we just talked about on your own. It will take a tremendous amount of time, energy, and effort, of course, but for some of you, that might be something you are doing or interested in doing. if you're interested in investing in this strategy and benefiting from our resources, our team, our infrastructure, that's mitigating risk, sourcing tremendous deal volume, doing all the analysis, underwriting, and then only investing in the best deals, you can do so through the DLP Preferred Returns Equity Fund. And this fund is a 5 to 8 year fund, which is about a year and a half into this fund. It has a target of at least an 8% return off of current income, off the rental income, and a 12% plus annual return net to investors, with a 7% preferred return. That 7% preferred return means investors earn 7% before we earn anything, including we don't even earn our management fee. And we get to these return profiles assuming our very conservative assumptions, and then we actually reduce those assumptions down even further by about 20% off of our returns to still be able to generate a 12% return next to investors. So in short, we should generate much higher returns in this over the course of our investments, but we're very comfortable we'll be able to generate very solid 12% plus returns with great current income, deferred from tax through depreciation. If you're interested in learning more about that, you can talk with Larry, Bob, or Mike, whoever you've already been in touch with, and they'd be glad to dive deeper into you with the fund and the strategy and so forth. So with that said, I'm going to go ahead and open the floor up for questions. Kyle will go ahead and ask any questions typed into YouTube or into Zoom here to me live. So feel free to go ahead and type those in. Happy to talk about whether it's specific to our underwriting, risk, our strategy, or anything in general you'd like insight on.
Awesome. Thank you so much, Don. And as an added little piece of bonus content in the chat after this webinar, I put a video in that shows this entire process in practice. So feel free, go click on the YouTube link after the webinar, and a really good video that can kind of sum this up in about 2.5 minutes. So excited to share that.
We should have told them that before they watched my whole presentation.
Sorry. All right, so we did have a few questions in, and like Don said, feel free to ask. We'll get everything answered. Richard asks, what size team do you have looking at potential investments? It seems like a great undertaking.
So DLP as a whole is 360 team members. The team involved in underwriting our investments, the actual investment team is about 12 people. And then we bring in the property management, redevelopment, asset management, accounting, legal, and lending team into these deals after we get to the point of doing our initial underwrite. When we get to the point of going on site, doing due diligence, getting lending quotes, finalizing our assumptions, et cetera, when we do the full underwrite, we end up bringing another 30 plus team members into that due diligence. So in our weekly investment discussion meetings, we have about 25 to 30 team members involved in the discussions in each of these investments.
Awesome. We have another one here. This one comes from Jerry. He asks, Don, are you still mostly focused on the Southeast? I heard you mention Arizona. Is there a push to move west as well?
So our markets, it's a great question. Our markets that we like to focus on for a lot of reasons is the Southeast, North Carolina, South Carolina, Georgia, and Florida. We have expanded out to the broader South quite a bit, largely just because of where do the relationships we built. We've been able to source really great deals. So we're willing and interested in continuing to expand our footprint. And we have recently. We've gone to Arizona, as you said. We've gone to Oklahoma. We're about to buy a property in Utah. We're also about to buy a property in Ohio. We've bought in Indiana. We've been pretty active, Mississippi, Louisiana, Alabama. But our biggest focus is the Southeast, but we'll go to markets that have the right supply and demand. And that's kind of an area I skipped over in this diving deep into, but supply and demand is the primary driver, in my opinion, of any investment. So we like to go to markets that have great demand, population growth, strong job growth, but has very little new competition coming to market in terms of more comparable apartments. And when we're in the B class, the value add space, there are no new apartments being built that are affordable that are in the B space. So generally, there's very little to no new supply coming into markets. So if you're in markets with great demand, which a lot of the broader South have great job growth, great from a tax standpoint, great weather, and are seeing tremendous growth and are great markets to be in.
Awesome. And I think you basically answered this next question, but just in case, Han Wei asks, what are your criteria for searching the target markets?
So we, a lot of times the first time we officially underwrite a market is when a deal comes to us. So unless, of course, we've already underwritten the market. And at this point, we've heavily underwritten 80 to 100 markets in the country, and we've invested in probably 25 of them. So, there's a good chance that the investment we've already, heavily underwritten. But if a new deal that looks like it's got all the right fundamentals, so, we get the property in, if we're not as familiar with the market, we go pull, a CoStar full market underwriting report, and we take time to study that market. And then we take time to go out on site and evaluate the market. We also reach out to vendors and relationships we have who know the market really well, and get their feedback and insights. We do a lot of legwork to get to know the market, when an opportunity presents itself. And then we generally are spending, a week plus on site in that market, when we're evaluating that asset. But to answer the question maybe more broadly, we're looking for the right supply demand fundamentals. We're looking for markets that have a diverse employment base, a growing employment base, and have population growth. And again, in the B class space, there's not really much of a concern in terms of new supply. But when we're looking at, and we do from time to time look at A properties, Class A properties, newer properties, and we will invest in Class A if we can buy it at the right price, and if there's very little new product coming to market. So when you get into the A space, you have to spend more time and energy on understanding the potential new supply. But those are things we look at a kind of an overall level, and then of course we get a lot of details from there. But that's the the general overview to what we focus on when we're evaluating a market.
And this is a follow-up here from Han Wei. It says, regarding property management, do you normally establish a local team, or do you do the management remotely?
So we always employ local management. So depending on if we're going into a brand new market, we evaluated both options of either A, hiring a third-party management company, at least initially, who has a lot of experience in that market. Sometimes we're considering evaluating keeping the existing management company. That's not all that often, but we do at least look at it. And then we're evaluating, taking over management ourselves. Any of those situations, whether we're going to manage it or we're going to hire a third-party management company initially, we're evaluating all the options, and any which way we're going to still employ on-site teams. So generally, for every 100 apartments at a community, we're employing 2 full-time people who are working at that property, sometimes living at that property. So at a 200-unit apartment community, we're going to generally have 4 to 5 full-time team members working at that property. So example, the property we just bought in Arizona, and we don't own any other apartment communities yet in Arizona. So when we went out and evaluated this property, it actually turned out to be a situation where they had a really good on-site team, a good manager, good staff, but they were owned by a loan servicing company that wasn't willing to invest money into improving the community. But it was a good management team who knew the property, who had actually been managing the property for a while. So we actually hired all the people who were already working at the community, but we terminated the existing management company and we took over the management. So now the on-site team reports to our regional management team, and then to our corporate management team. And they, and our corporate team, flew out there, 3 of our senior executives and a couple of our other supervisor level team members, and our culture ambassador all went out to that property and spent the first week with them, welcoming them, training them up to our systems, et cetera. And when we evaluated that process, we also did evaluate hiring a third-party management company. But after evaluating all the options, we determined that the best opportunity in this case was to keep the on-site staff and manage it ourselves.
Awesome. We have a couple here from Tom, so I'll ask them together. Your minimum amount of investment on your minimum amount of investment on your purchases, and did I see you have a presence in Canada?
So tackle Canada first. No, we do not have a presence in Canada at this time. Have never yet evaluated going to Canada. In terms of minimum investment, if your question is how much do I invest into the property, I'm assuming what that question is. So my minimum investment, technically, that I'll put into a property is a minimum of 5% of the investment. But generally, I'm putting in significantly more than that. So across our real estate portfolio, I have over 40% ownership in our entire portfolio. And more common is I'm investing 25 to 50% into every property we acquire. So we do not go out there and sell an investment as a good deal to our investors and not invest in the properties. We also don't go out and make decisions on buying an investment property based upon bringing in somebody else who wants to invest in that property. We go and do all of our underwriting. We make our decision to buy that property, and then we bring the fund or our investors into that property. And again, every investment property we buy, I'm investing a significant amount of capital, and almost always I'm the largest investor in that property.
All right, and this one comes from Doug. We have a few more here, but this one's from Doug. He says, as DLP has grown in internal resources, how are you leveraging internal spend toward gaining a stronger position in the Class B multifamily market space?
Yes, that's a great question. So there's a lot of ways. First is as we've grown in size and reputation and track record, it's helped us a lot in that we've built a lot more relationships with banks and auction houses and brokers and directly with owners and sellers. And so we get a much broader base of deals coming to us, number one. And then when we're putting an offer out on a property, people know that who we are. They know that we're buying a lot of properties. They know that we execute. They know we're good to deal with. They know we have our capital, et cetera. So it helps us to negotiate to get the deal and to get the best deal. And in terms of how do we use our scale to drive efficiency and maximize our returns, first is knowledge. And when you've done, most things we're going to come across, we've done it before, we've tackled the issues before, whether it be management, whether it be, exterior improvements to the property, whether it be adding amenities, whether it be knowing, how to maximize the interior renovation of an apartment. We have the knowledge and experience and expertise within our team on how to do it to get the biggest yield on our spend. And then because of our size, we're able to negotiate the best deals with large vendors, whether those be large suppliers, contractors, service contracts, et cetera, from laundry to our actual building supplies to you name it. We're able to get large discounts from the largest suppliers in the country, as in many cases we're one of the largest accounts of a lot of the biggest suppliers. In a lot of cases, a lot of our contractors, from roofers to GCs to plumbing to electrical, we're one of their largest clients. And they know not only are we large, that we can give them a lot of business, but they know that we pay on time. Generally we pay faster than everybody else, and that we're going to be, good and fair to work with. So, it makes a big difference in not only getting the best pricing, but getting work done quickly, getting them to be focused, especially when you're in a bind or you need to move really fast, or, being able to have resources that you can count on to execute, and that we know will execute because we have experience with them as well.
Awesome. And this is another question from Doug. It says, why not expand or segue into smaller sub 50 unit multifamily properties, especially in the Southeast, which has a predominance of small to medium sized towns?
So the sub 50 unit properties, it's how we started. We bought the small, I call scattered multifamily properties, and I call them scattered because the problem or the challenge with managing small apartment communities at our scale today, if we were only investing in one market, it'd be one thing. So example, in Daytona Beach, we own lots of small scattered single family and multifamily. We have a large centralized team of 25, 30 people out of Daytona, and we own a bunch of scattered properties across a 10, 15 mile radius. So in situations like that, it can certainly work. It's definitely a strategy that can work well. We own still right now probably 500 scattered units in and around Lehigh Valley. And so, can work in those types of situations, but to go into a new market and buy those types of properties are very, very challenging, because at a 50 unit apartment community, I can't afford to have any on-site staff members, or at most I can afford one kind of lower paid staff member. And so if I have one staff member at a property in, Jessup, Georgia, and I lose that one person, or that person doesn't do a good job, we're going to have some poor performance of that property for a period of time, because we don't have scale at that property. If in that market I own 10, 50 unit properties, now you have the resources. So it's very challenging to get the level of scale, and in turn then to get the level of efficiency, of consistency. Same thing goes with your residents. In a 50 unit apartment community, if 5 tenants move out this month, you're down to 90% occupancy, and your cash flow drops a lot. At a 300 unit apartment community, you're going to have much more consistency in your occupancy and so forth. So for a lot of reasons, you just get a lot of benefits out of scale. But with that said, for people looking to go out there and acquire and build a portfolio, that's how we started with buying the 20, 30, 40, 50, 60 unit apartment communities, where you're going to get better pricing, you're going to get less competition. And if you do it in a close-knit geographic area, you can get similar levels of efficiency as you can get in larger communities.
All right, we have one here from Greg. It says, do you have a backlog of investable monies versus what's available for properties to buy?
So managing deployment of capital, having the capital to feel confident to go out and put a property under contract and, put a large deposit down and go hard on that deal, knowing and being confident you have the capital to close that deal, versus the other side of the equation of having capital but not having deals to go into, is one of the biggest challenges in a business like ours is managing that flow of deals and money. I can say from our vantage point, we've done a tremendous job of managing that challenge over the many years. Generally, we've deployed capital very, very fast. Historically in under 30 days. Typically long for us to deploy capital takes us around 60 days. And then on the other side, we've never passed on an investment or not been able to close on a deal because we didn't have capital to close on that deal. So we've always had a good balance of deal volume and capital, and partly, we've just done a good job of balancing that, but also largely how we structure our strategy and our goals is we structure our capital raising and growth goals to match our investment goals of acquisitions. And generally we've been able to match that up pretty effectively. And then I sort of fill the gap a lot of times. And that's why sometimes I invest less, sometimes I invest more in a deal. If we don't have enough capital as in the pref fund to take down the property, then I invest more money. So I end up serving as sort of a backstop in a lot of cases to be able to deploy the money needed to close a deal.
All right, we have a couple more. This one is from Bob, different Bob. It says, do you accept sophisticated investors?
Yes. So, all of our investors in our funds are accredited investors, which depending on how you're defining sophisticated investor would be considered a sophisticated investor. So I'm not sure exactly how you're defining that, but yes, all of our investors are accredited, which means you have $1 million in net worth or $200,000 in annual income, one or the other, which based on the SEC definition would be a sophisticated investor.
And this one is another one from Hanwei, very active Hanwei, thank you. Says, what is your strategy for leverage? Do you try to maximize the leverage of a loan you could get, or you try not to exceed certain percentage?
Yeah, great question. So across DLP's portfolio as a whole, we're mid 50s on leverage, 55% loan to value. Generally, when we buy a property, we're taking out 65 to 70% leverage at purchase. But then we're coming in there and we're investing capital and resources into improving the asset, improving the value of the asset, which then decreases our loan to value and our loan to cost, which is why as a portfolio average, we're about 55%.
All right. We did have a couple more coming in. Don, if you have time, I'll ask these ones.
Yep. I got about 2 more minutes here.
All right. So this one comes from Tom. It says, how would you compare DLP with a national REIT?
It's a good question. So, right now we are planning, next year we will launch a large private REIT structure, which will be structured, in all material ways, the same as the pref fund that we just talked about. But in terms of a REIT, you're referencing a national REIT, you're probably referencing a public REIT, meaning a REIT you could buy through, the stock market. So, I would compare us in some ways we're very similar, and in some ways we're very different. So the first way we're very different is we don't have any commissions that go out for raising capital or paying the fees associated with being on the compliance fees and so forth of being on the stock market. So generally, when you invest in a public REIT, 10% of your investment goes out into fees. We have 0 fees. So that makes a tremendous difference, of course, in the underlying return when 10% of the money is going out in fees versus nothing's going out in fees. So that's one significant difference. Another significant difference is generally these large public REITs don't have the level of boots on the ground and are too big to tackle the level of effort we go into to buy properties at large discounts and then to deploy heavy value add renovation strategies. So they generally just can't do those types of properties. So they're generally more buying properties after renovation and paying kind of the premium to not have to do the heavy value add strategy that we do. So generally they're kind of guys buying at the prices we're selling, not buying at the prices we're buying. And then the third big difference I'd say is that public REIT's value is based on, perception, emotions, and what Trump said today. So your value of your investment can fluctuate and change, and what you pay for that investment a lot of times doesn't have all that much to do with the value of the underlying real estate. Versus with us, what you're investing is exactly based upon the value of the underlying real estate. Those are a few of the difference, but investing in public REITs can be a great part of any investment portfolio and can be definitely something worth doing. There's some really good ones out there like, BlackRock that do generally a great job.
That's all I have for questions. I do have a remark here from yet another Bob that I would like to share. It says, I had an awesome time in Asheville for the Inner Circle event. Just wanted to say thanks to Don and the team for their hospitality.
Awesome. Thanks, Bob. Appreciate that. Have a great rest of the day, everybody. Appreciate the great engagement, and we look forward to helping you evaluate this further if it makes sense for you.